Hello guys, welcome to another video. Today we are going to talk about lessor accounting, and from lessor point of view we have three types of lease. First lease is called sale type lease, second is called direct finance lease, the third is called operating lease. How the lessor will classify the lease as sale type or direct finance or operating lease, we have already covered in the previous video. I will provide you the link of that video in the description of this video. So I'm assuming in this video the lease is properly classified as sale type lease and how the lessor will perform the accounting entries. So here we go guys. Before going into the definition, into the detail, just let's cover first basic definition. The first definition which we are going to talk about, that is called lease receivables. Because in the sale type lease, the lessor has to record the revenue also, and lessor has to record the cost of goods sold also. Okay, so the revenue is always equal to lease receivables. So that is why, what is the lease receivables? Actually, lease receivables will include the present value of lease payments. Lease payments mean to say installment. Like simply we need to calculate the present value of the installment which we are going to receive over the lease period. And we will add plus present value of guaranteed residual value by lessee or by any other third party. Okay, so here guys, you should remember, for example, if you have total expected residual value which the lessor will drive at the end of the lease period, maybe for example $50,000. Okay, out of $50,000 there is the residual value which is guaranteed by lessee or by any other third party. For example, it is $40,000. So guys, the remaining $10,000 which the lessor will obtain through the asset, through the sale of asset, which is extra over and above the guaranteed residual value. So this is called unguaranteed residual value. Okay, so in this calculation, when you calculate the lease receivables, you have to take present value of guaranteed value, in my example, which is 40,000, to calculate the lease receivables. Okay, guys. And when you want to calculate the present values, of course, we always need a discount rate. So which discount rate we will use? The discount rate which is implicit in the lease. Implicit rate mean to say the rate which is charged by lessor to the lessee, and equal to the lease receivables. Equal to the lease receivables, what we will do, we will record the revenues, okay, in our income statement at the lease commencement date. Okay, now guys, I have already told you what is the unguaranteed residual value. Unguaranteed residual value is the amount that the lessor expect to drive from the leased asset at the end of lease term, that is not guaranteed by any party. And in my example, the unguaranteed residual value is 10,000. Okay guys, so then third we have another definition which is called investment, net investment in the lease. Okay, what is net investment in lease, guys? If you will take, please you should remember, like for example, if you have taken present value of lease rentals plus present value of guaranteed residual value by lessee or third party, this is equal to lease receivable. If in the lease receivable we will add here present value of unguaranteed residual value, so this is equal to net investment in the lease. Okay, in short, net investment in the lease includes full guaranteed residual value. Like I would say 50,000, it will be included. Okay, so you should remember, please. But when you want to record revenue, revenue should be recorded up to the lease receivables, up to the lease receivables, up to this value. Okay, but when you want to record net investment, it should include lease receivables plus present value of unguaranteed residual value. Now guys, you should remember this point also. The present value is calculated using the rate implicit in the lease, and the net investment in the lease is fair value of the leased asset. Actually guys, in the sale type lease, what will happen, the net investment in the lease, actually what is net investment? As I told you, it's the present value of the total cash, which include lease rentals and full amount of GRV and other assets that the lessor expect to receive over the lease term. It will be equal to the fair value. So in short, what I'm saying, net investment in lease will be equal to the fair value of the assets. Okay, so you should remember these definitions, please. Then guys, here we have here, if you want to calculate the selling profit, how the lessor will record the selling profit, because selling profit should be the difference of revenue, because revenue you will record equal to the lease receivables minus what, cost of goods sold. And cost of goods sold, how you will calculate guys? So you need to calculate the cost of goods sold, you need carrying amount of the leased asset, which will be provided in the question. From the carrying value you have to minus what, present value of unguaranteed residual value. Okay, present value of unguaranteed, not guaranteed, unguaranteed residual value. So this will be equal to your cost of goods sold. Okay, and we will record the cost of goods sold also with this value. So in some questions, maybe if there is no unguaranteed residual value, in that scenario, the carrying amount of the asset will be equal to your cost of goods sold. And the difference of this is called selling profit or loss. Okay. And here we have a short note. A lease can be classified as a sale type lease even if it does not result any recognition of any selling profit or loss. Now guys, let me just tell you here, actually in the sale type of lease we have two types of profit mostly. Which two types of profit? One is called selling profit. So selling profit is the difference, as I told you, of revenue and cost of goods sold. And second is what we have, our interest revenue, which we will record over the lease period, over the lease term, by using effective interest method. So even what is this note, even that you don't have any selling profit, maybe why you don't have selling profit, maybe revenue is equal to cost of goods sold, so you don't have any selling profit, so still this lease could be classified as sale type lease. Now guys, here I'm going to talk about it after basic definition. So now we are going to discuss about initial measurement. This is really important. Like initially, as a lessor, what you have to do guys, which entry you will pass at the lease commencement date. So here we have entry guys. So first of all, we have to debit what, net investment in the lease, which is equal to the, like, what value we will use the fair value of the asset. If it is not given straight away, how you can calculate the fair value of the asset guys? I told you, you have to take present value of lease rentals plus present value of residual value guaranteed by lessee or any other third party, which is equal to lease receivables, plus we will add here present value of unguaranteed residual value. So this is equal to your net investment in lease, which is equal to the fair value of the asset. So that is why with this amount we will debit the net investment in the lease with the fair value of asset. Okay, if fair value of asset is not given directly, so this equation you can use to calculate it. Now guys, here we have, here you have to debit the cost of goods sold also, cost of goods sold. And cost of goods sold we will always use carrying value of asset minus what, present value of unguaranteed residual value. Okay, present value of unguaranteed residual value. So if present value of unguaranteed residual value is not given, so your cost of goods sold will be equal to the carrying value of asset. So this amount you will debit. Okay, and the credit, what credit, you will book the revenue. Revenue is always equal to lease receivables, and lease receivables include, I told you here, this is how you will get it, includes present value of lease rentals plus present value of residual value guaranteed by lessee or third party. Okay, and the credit, you have to credit the asset also, because asset you need to derecognize. So which value we will use? We will use the carrying value of the asset. Okay, so it means on the sale type lease, if there is any profit, we are recording. How profit is recorded? Because you have recorded the revenue also, you have recorded the cost of goods sold also, automatically the difference will be the profit in the income statement. Okay guys, so this is the entry, initial measurement. And here we have a few more points, because sometimes there could be a initial direct cost, okay, relevant to the lessor. The lessor, which lessor might pay some direct cost like finders commission, etc. So if you have any initial direct cost, so at the at the time of initial recognition and measurement, guys, so you also need to treat with the initial direct cost. And here the first point is what, for the initial direct cost, if there is a profit or loss means your amount of revenue which was equal to lease receivables, and cost of goods sold, I told you, which is equal to carrying value of asset minus present value of unguaranteed residual value, right? This is equal to cost of goods sold. So if it is different, it means there is a profit or loss. In that scenario, what you have to do, whatever the initial direct cost has been incurred by lessor, so those direct costs should be recorded as a expense. It means one more entry you need to record at the initial recognition and measurement date for the initial direct cost. And what entry you will pass, you will debit the lease expense with initial direct cost and you will credit the cash. Now we have a second scenario for the initial direct cost, guys. What is the second scenario? If there is no profit or loss. No profit or loss means say the fair value of the asset is equal to carrying value of the asset. So there is no profit and loss. In that scenario, so whatever the initial cost which lessor has paid, we need to defer and recognize in the direct, we need to recognize the direct cost over the lease term. So you should not expense out, you should capitalize, and it should be recognized over the lease term. But how? Maybe you are thinking, guys, actually you don't need to do anything as a student regarding this case. Which case? If there is no profit. And how it is deferred, guys, please note, as a student you don't need to add them separately in the net investment in the lease, because practically what lessors they do, they add initial direct cost into net investment of lease. They will add initial direct cost. Okay, as a student you don't need to add. The reason is that as initial direct cost which we need to defer are adjusted through implicit interest rate. Maybe this point is little bit hard to absorb, guys. Actually what I told you, as a student you don't need to add separately into the net investment of lease. No, it is always reflected through the implicit interest rate. You don't need to do anything. Now maybe you are thinking, implicit interest rate, how the lessor will calculate, guys? Actually, so this calculation is also not part of your exam, okay, because it's bit of finance area. So the implicit rate of interest is the rate which will equate these two sides of the equation. Which two sides of the equation? The first side is what? Fair value of the leased asset. In that, lessor will add initial direct cost. Okay, so what it will be? It should be equal to present value of lease payment plus present value of amount that the lessor expects to derive from the leased asset following the end of lease term. It means here full amount of GRV. Actually we are talking about full amount of GRV, full, even it is guaranteed or unguaranteed. So lessor will calculate that rate. Okay, the rate will equate these two, this equation. Actually that is called implicit rate. It means what I'm trying to tell you, if there is no profit, so initial direct cost should be deferred and recognized. And how it is recognized? It is adjusted through the implicit rate. And in your exam, you will be provided with the implicit rate. You are not required to calculate implicit rate, okay? Because implicit rate is a finance calculation, and lessors do the calculation of internal rate of return. You can apply this formula in the Excel sheet also, but it's not your part, okay? So you have to be aware with this part. If there is a profit or loss, initial direct cost should be recorded as a expense, and you have to pass this entry as a student. And this case you don't need to worry, because it will be adjusted in the implicit rate, and implicit rate will be provided you in the question. Then guys, here we have it. Now we have a question for the initial measurement, and I'm going to deal with both, with guaranteed residual value and unguaranteed residual value. Here guys, we have a question number 1, and here I'm assuming here we have a guaranteed residual value only. We don't have any guaranteed residual value. Plus we are making payments in area. This is the assumption, because advance payment I will cover at the end of this video. So guys, here we have example. Alpha company sells and leases unspecialized machine on January 1, year 1. This is the date. Alpha leased a machine to Beta company for 3 annual payments of 100,000 starting on December 31st, year 1. It means there are 3 payments of $100,000, and each payment is at the end of the year. The machine's remaining useful life is 5 years, but lease term is 3 years. Okay, guys? Okay, the expected residual value of the machine at the end of year 3 is how much? $30,000 is the residual value. And beta guarantees this amount. It means this amount is fully guaranteed by beta. It's guaranteed residual value. At the inception of the lease, fair value of the machine equal to 271,224. As I told you guys, fair value of the machine means say it's a net investment in the lease. Okay, and the carrying amount was how much? $250,000. The rate implicit lease is the 10%. This is the implicit rate, which is 10%. Okay, the present value factor for an ordinary annuity at 10% for 3 period is this. This is the annuity factor is provided at 10%. And the present value of $1 at 10% for 3 period. This is what is your present value factor is provided here. Okay. Here is the annuity factor and this is the present value factor. Now guys, this is the question now. What we need to do here, simply first we need to calculate the present values. Okay. And how you will calculate the present value? There are two cash flows are there. The first cash flow is called present value of rentals. And annual rental is 100,000 multiplied by, we need to multiply with the annuity factor at the rate, implicit rate, which is 10% for the 3 period. And this annuity factor is also provided here. Okay. Otherwise you can calculate the annuity factor or you can use the annuity table. It's ordinary annuity. Okay. So you will get the present value of lease rental. Then you will add here present value of residual value guaranteed by lessee. And there is a guaranteed residual is 30,000, which is given into the question here. You have to multiply with the present value factor, which is 0.7513. So you will get another present value. Just add these two cash flows and it's going to be equal to the fair value. And by the way, guys, fair value was given here, 271,224. And guys, of course, it is a sale type lease. Why? Because 90% criteria is met. If you remember, there is a lease classification test. Like if the present value of lease payment, okay, you will divide with the fair value of the asset, multiply by 100. If answer is 90% or more, so from lesser point of view, we can classify as a sale type lease. And here it is almost 100%. Okay, guys. Now the point is that what entry you will pass now. The entry, guys, so you will debit the net investment in lease with the fair value of asset, and fair value of asset here is equal to net investment in the lease. Here we calculated here as a present value also. Okay, and guys, here you have to debit the cost of goods sold. The cost of goods sold with always with the carrying value, and from this carrying value you need to subtract if there is any present value of unguaranteed residual value. But in this question we don't have any unguaranteed residual value. And then you will credit here revenue. Revenue is always with the lease receivables. And guys, in this question, by the way, you remember I told you present value of lease rentals plus present value of guaranteed residual value by lessee. It's called lease receivable. And here I will add present value of unguaranteed residual value, which is not here. It means this will be equal to net investment. In this scenario, my receivables are equal to the net investment. The reason is that I don't have any unguaranteed residual value. So I will credit the revenue with the lease receivables always. And I will credit the machine with the carrying value, and carrying value machine is given here as 250,000 above in the question. This is your initial measurement. Okay. Now guys, I'm going to deal with the question if you have unguaranteed residual value also. Initial measurement again, and we don't have direct cost here, guys. Again, here I'm assuming we have here initial measurement, and we have here guaranteed residual value and unguaranteed residual value also, plus we are making payments in, or we are receiving payments in arrears. Okay, so here we have a Soma company, sells and lease unspecialized machine on January 1, year 1. Soma leased a machine to Viva for 3 annual payments of 100,000 starting on December 31st, year 1. Their lease duration is 3 years. Machine's remaining useful life is 5 years, but lease term is 3 years. Expected residual value of the machine at the end of year 3 is 40,000. This is the expected residual value. The residual value guaranteed by Viva is 30,000. So total is 40, but guaranteed is 30. It means 10,000 is unguaranteed residual value here we have. Okay. Then the fair value of the machine is 278, 370, 737. This is what is the fair value machine. And carrying value machine is 250,000. Rate implicit in the lease is 10%. And here we are provided with the annuity factor also, guys. Annuity factor for 3 years at 10% is this one, and the present value factor of $1 at 10% for 3 period is this one. Now guys, you have to first of all apply, check its sale type lease or not, guys, when you want to apply 90% test here, because if you remember, if there is a transfer of title, or if there is a purchase option, or if there is a 75% test, I mean say lease period covers the majority of the asset remaining useful life, or if present value of lease payments is greater than 90% of the fair value, or if it is specialized, if any one criteria is met, we say it is a sale type lease. And guys, here I'm applying 90% test. Okay, 90% test, how you will calculate? You need a present value of lease rentals, which is $100,000 annual cash flows, multiplied by annuity factor, which is this one. So you will get the present value of lease rental, and we have to add here plus present value of residual value guaranteed by lessee, which is 30,000, because total was 40 but guaranteed is 30. You will take 30,000 guaranteed, multiply by present value factor, which is available here. So you will get another answer. So once you will add these two present value, guys, so this is called, this value you will use in 90% test. Please, when you want to apply 90% test, you should not apply, you should not include present value of unguaranteed residual value, please. Okay, you should remember. So if you will apply here now without unguaranteed residual value, my total present value is 271,224. What I will do here, guys, I will take this value and I will divide with the fair value. Fair value of the asset is provided here into the question, 278, okay, 737, and we will multiply with the 100. So you will get the percentage, and it is equal to here almost 97%, so which is more than 90%. It means it is a sale type lease from lessor point of view. Okay, and guys, here you should note one more thing. Here in this calculation, I have just included lease rentals and guaranteed residual value, so which is equal to lease receivables, which is equal to lease receivables. If in this lease receivables, if I will add present value of unguaranteed residual value, as I told you, this is our lease receivables. If I will add here present value of unguaranteed residual value, unguaranteed, and unguaranteed value is how much? $10,000, because total guaranteed was 40. Total residual value was 40 and guaranteed is 30. So unguaranteed is 10,000. If I will add here, multiply by present value factor, which is 0.7513, I will get here another value. Okay, another value. If you will add present value of lease rental plus present value of guaranteed residual value plus present value of unguaranteed residual value, it should be equal to the fair value of the asset, and it will be equal, by the way, guys. Okay, and it will be equal, which it will be, total will be now 278,737. Okay, now guys, we have to pass the entry because it is a sale type lease. So first of all, you have to debit the net investment in lease will always with the fair value, always. And fair value includes three calculations here, right? Present value of lease rental plus present value of guaranteed residual value plus present value of unguaranteed residual value. I'm repeating so many times because you should not confuse it. Then guys, you have to debit the cost of goods sold. Cost of goods sold, how? You need a carrying value of asset minus present value of unguaranteed residual value, and unguaranteed residual value was 10,000 times this present value factor. So if you will minus it, like carrying value minus present value of unguaranteed residual value, this will be your cost of goods sold. Okay, cost of goods sold. Then guys, you have to credit the revenue. Revenue is credited always with the lease receivables, and as I told you, lease receivables are here. This was the amount of lease receivables. It should include only present value of lease rentals plus present value of guaranteed residual value by lessee or lessor. Okay, lessee or any other third party. And then you have to credit, guys, here machine is always credited with the carrying amount, which is 250,000. So this is your entry, and there is no initial direct cost. Now guys, here let me just tell you how you will deal with the subsequent measurement. Okay guys, subsequent measurement, guys. So here it's really important, guys. In subsequent years, what you are going to do, each installment which you will receive, each lease payment received has always two components for lessor. One is called interest income, and second is called reduction of net investment in the lease, I mean say with the principal amount. Okay, And which method we are going to apply? We are going to apply effective interest method. And if you want to calculate your interest income, how you will calculate interest income? You need net investment in the lease at the beginning of the period multiplied by discount rate, which you have used in the present value calculation. Okay, and then if you want to calculate reduction in the investment in the lease, what I need to do? Reduction of net investment in the lease, I need periodic lease payments, I mean installment, minus interest income recognized. So you will get the reduction of net investment in the lease. And guys, you should also remember, because as a lessor in the sale type lease, we have already derecognized our assets, so we will not charge any more depreciation. Okay, now guys, so for the subsequent measurement, so how you will prepare the schedule? I'm continuing with the first example. In the first example, the without unguaranteed residual value. So what we have to do, guys, there was 3 years of the lease term, year 1, 2, and 3. Okay, and we have here the column for beginning net investment in the lease times interest percentage, which is here 10%. Okay, this will give you interest income. You are receiving installment, you will get reduction in net investment in lease, and here you have a closing net investment in lease. Okay, now guys, please, you should remember, in the first example, let me show you that example first. So you should continue. This was our first example, guys. This was our first example, actually, this example, question number 1. And here we have here net investment in lease. If you remember, we have booked here with 271,224, and discount rate is 10%. Okay, discount rate is 2%. So I'm dealing with this here. Now guys, preparing the schedule for net investment in the lease. This is how you will do, guys. So first of all, in year 1, you will place the year 1, 2, and 3. In year 1, guys, you will start with the beginning net investment in the lease, which you have booked the entry, okay, at the start, initial recognition, and your net investment in lease was debited with 271,224. You will multiply with the 10% because discount rate was 10%. This will give you interest income. Like if you will multiply these two, this will give you interest income. And your installment is 100,000 in year 2. In year 3 is 130, because in year 3 you have a installment of 100,000, plus you have a residual value guaranteed by lessee 30,000. So it means 130 you will receive in the last year. So I placed here cash flows. In the first year we have a installment 100,000. The difference of installment and interest is called your reduction in net investment in lease. Now what you will do, guys, here you will take opening balance minus this reduction in net investment of lease. This will give you closing net investment in lease. Okay, this closing, guys, will become opening for next period, again times 10%. This is going to be your interest income. The difference, installment is 100,000. The difference between these two is going to be a reduction in net investment in lease. And if you will take beginning minus reduction in net investment of lease, you will get closing balance. This closing is going to be the beginning for next period times 10%. This is going to be interest income. And in the third year, you are going to receive 130,000, including installment plus residual value guaranteed by lessee. So the difference of these two is the reduction in net investment in lease, and this is equal, and here your balance will be 0. Now guys, here you should remember, please, the presentation, because as per standard you should present your net investment in lease in current portion and non-current portion. So how you will split here, then I will tell you entry, what entry you will pass. Now guys, in year 1, for example, I'm doing the calculation for year 1 first. How you will present in year 1, your total net investment in lease is how much? 198,347. So this is what we put it here. So in year 1, our total net investment in lease is 198,347. And how much is the current and non-current portion? The amount which I'm going to receive in the forthcoming period. Forthcoming is, this is the forthcoming reduction in net investment in lease. This is going to be my current, and the remaining is going to be my non-current. And this is how the total is equal to 198. Okay. In year 2, what I will do, guys, in year 2, if I want to do the calculation for year 2, this is my total, I mean to say net investment in lease. I will show total. And what will be the current portion? The principal amount which I will receive in the next period, which is this one. It will be my current, and remaining which will be shown here, it is non-current. And in year 2, non-current will be 0, because lease duration is 3 years only. Okay, guys. Then guys, we have to pass the entry. What entry you will pass, guys? Every year you will debit the cash, okay, because you are going to receive with the installment amount. In the first year I will take this debit, and you have to credit the interest income with this value, and you have to credit the net investment in lease with this value. In year 2 I will use these values, in year 3 I will use these values, and this is what is the entry. Let me show you entries now. And in third year, there is a trick because you are taking asset back also. 30,000 residual value is there. So here we go, guys, with the entries. So in year 1, you will debit the cash with 100,000. You will credit the interest income with 27,123. You will credit the net investment. This is with the principal amount. In year 2, you will again debit the cash of 100,000. You will credit the interest income with the interest income value, and this data you will take from that above table. And the third is what? Net investment in the lease with the reduction value. Okay. In year 3, guys, you got a cash of 100,000, plus you are going to get back machine of 30,000. You will debit the machine. You will credit the interest income. You will take from year 3 data, and you will credit the net investment in lease with this data. So these are the entries, guys. Okay. Now just let me show you how you will deal if the payments are in advance. So I will show you from the question, because the point is only the schedule, how to prepare the schedule. So here we go, guys. Here I'm assuming if you have payments in advance. For example, B company leased equipment to M Inc on January 1 year 2. This is the date of lease. January 1 year 2, like at the start of second year. Okay. The lease is for an 8 years. This is the lease duration, expiring 31st December year 9. The first of 8 equal annual payments of 600,000 was made on January 1 year 2. It means first payment you got on the lease inception date, and each payments, there are 8 payments are there, and 600,000 is the amount of each payment, and first payment is in advance. B had purchased the equipment on December 29 year 1 for the cost of 3.2 million. This is actually the cost, because 1-2 days before the lease you purchase this equipment. The lease is appropriately accounted for as, this is sale type lease. Assume that present value at January 1 year 2 of all rent payments over the lease term discounted at 10% interest was this. This is the present value, it already told you. Otherwise, guys, you can calculate the present value. Okay. If you want to calculate the present value, this is annuity due concept is there, guys. Annuity due. So there are different ways to do it. If I want to calculate present value, I will take annual cash flows, which is going to be $600,000, and I will multiply with the annuity factor. Okay. I will take annuity factor of year 7. Why? Because there are 8 payments, and first payment we made it today. 0, 1, 2, 3, 4, 5, 6, and 7. So these are 8 payments. 1, 2, 3, 4, 5, 6, 7, 8. So there are different ways. So I have to take annuity factor of year 7 at 10%. And in that I will add 1. 1 represent year 0 present value factor. Okay. So if I will multiply this cash flows with this, so I will get the present value, and which should be how much? 3.52 million, and he already told you, by the way. Okay, guys. So we have here present values already. What amount, he's asking question, what amount of interest income should be recorded in year 3, I mean say second year of the lease period, as a result of the lease? So he's asking about interest income. It means, guys, so simply you need to prepare the schedule. And how you will prepare schedule, because this is only a trick in the advance payment. So simply what we will do, guys, we will write this column: date, net investment in lease, we have interest percentage, reduction in net investment in lease, and we have a net investment in lease ending balance. Okay. So guys, this is our date of lease. Let me show you question if you want to verify data also. Okay. So here, this is our date of lease, 1st January year 2. It's given here. And at that day, we have already present value, how much? 3.52 million. We will put it here. Okay. This was the total present value. And on the same date, we got a first payment of 600,000. There will be a no interest because there is no time elapse. And this 600,000 directly will reduce your net investment in lease. It means your net investment in lease is going to be 3.52 million minus this value is equal to this value. Okay, at the date of inception. Then what we have, guys, we have a 1st January year 3. Okay, at the next payment, again, we made 600,000. We received actually $600,000. Now guys, I want to calculate interest. You know how I will calculate interest at this date? I will take this value, the last value, multiply by interest percentage. It's going to give me the interest value here. And my receipt, I mean say installment is this. And if I will take the difference of installment and interest, this is going to be reduction in net investment in lease. Now I will take this value minus this value is going to be this value. Okay guys, now we have a next payment also on 1st January year 4. Again we got 600,000. Now how I want to calculate this interest? I will take the previous value, this value, times 10%. It will give me this interest. The difference of interest and installment is going to be reduction in net investment of lease. And if I want to take the next balance, I will take this minus this value is equal to this value. Now guys, what was the question? Look at here. He's asking what amount of interest income should be recorded in year 3. Year 3 means, guys, you can just look at the dates here. Actually, the start of year 4 means end of year 3. It means your answer is in this line. If he's asking for year 2, the start of year 3, it means the end of year 2. So he's asking for year 3 here, guys. Year 3 means the start of year 4. We can assume it's the end of year 3, and this interest we will accrue. Okay, what entry you will pass at the end of year? You can debit the installment receivables, credit the interest income with this value, debit the installment receivable with this value, and credit the net investment in lease at this value. This entry I'm talking about year 3 entries. Okay, and the day, very next day, once you will receive the payment, you can debit the cash and credit the installment receivables. Okay guys, so this is, it means this is the answer. This is the interest which should be accrued for 3rd period. Now guys, I'm just going to tell you how to deal with the financial statement presentation. Please guys, I have already told you about this point. Like when you have net investment in the lease, that should be separated into the current portion and into the non-current portion. I have already told you. And second thing, in the balance sheet, the net investment in the lease asset resulting from sale type lease and direct finance lease. Direct finance we will cover in the next video, are aggregated and presented together. Okay, presented together. And the third, for the statement of cash flows, guys, all cash receipts, even it is sale type, direct finance, or operating lease, from lessor point of view, we will record as a cash inflows from operating activities. I hope guys it is clear. Thank you so much. See you next time. Bye bye.